At some point, investing stops feeling like a puzzle to solve and starts feeling like a responsibility to manage. Early on, numbers feel exciting. Charts move, percentages change, headlines promise opportunity. There is a quiet thrill in believing that the right calculation, the right insight, or the right moment can unlock something meaningful. Over time, that feeling changes. Numbers stop being abstract. They become attached to real things: time, security, choices you may or may not have later. Many investors never make that transition. They keep searching for more information, more indicators, more confirmation. They believe that complexity equals safety. If they can just check enough data points, they assume mistakes can be avoided. I used to think that way. I believed better analysis would lead to better outcomes. What I eventually learned is that clarity matters more than quantity. Not because the market is simple, but because human behavior is fragile. The market does not punish ignorance as quickly as it punishes overconfidence. Not knowing something can often be corrected. Being certain about the wrong thing usually cannot. Most serious investment losses do not come from missing information or a lack of intelligence. They come from paying attention to the wrong information and assigning it far more importance than it deserves. When you look back at major investing mistakes, whether your own or those made by others, a clear pattern emerges. The issue is rarely that someone failed to calculate. In fact, many mistakes are backed by very detailed calculations. The real problem is that those calculations were focused on variables that did not truly matter. Precise forecasts of revenue growth, complex models built on fragile assumptions, confident narratives that left no room for uncertainty. The math looked impressive, but the foundation was weak. Overconfidence often hides behind sophistication. The more elaborate the analysis, the easier it becomes to believe that risk has been tamed. But markets do not reward effort. They reward sound judgment. When confidence outruns reality, losses tend to arrive suddenly and without negotiation. Over time, I noticed something quietly consistent among long-term investors who built wealth without drama. They did not obsess over dozens of metrics or constantly update their views based on the latest data. Instead, they returned to the same few signals again and again, not because those signals could predict the future with accuracy, but because they imposed discipline. These investors understood that investing is less about foresight and more about behavior. The right metrics acted as guardrails. They prevented extreme decisions during periods of excitement and panic. They limited exposure to fragile situations. They forced restraint when optimism ran high and provided confidence when fear dominated. Importantly, these signals were simple: price relative to value, balance sheet strength, the ability of a business to earn solid returns on capital over time. None of these offered certainty, but together they reduced the likelihood of catastrophic mistakes. They did not tell investors what would happen next. They helped ensure that whatever happened next would be survivable. This approach may feel unsatisfying in a world that celebrates precision and prediction. It offers no bold forecasts and no dramatic calls, but it aligns with how markets actually behave. The future is unpredictable, but the consequences of poor structure are not. Fragile businesses fail. Over-leveraged balance sheets break. Overpriced assets disappoint. By focusing on what truly matters, disciplined investors avoid the temptation to overreach. They accept that some opportunities will be missed. They accept that they will never buy at the bottom or sell at the top. What they gain in return is durability. The ability to stay invested, stay rational, and let time do its work. In investing, the goal is not to be right often. It is to avoid being wrong in ways that cannot be repaired. Guardrails matter more than guesses, and humility paired with the right focus is one of the most underrated advantages an investor can have. There are only a few numbers that truly deserve your attention before buying any stock, not because they guarantee success, but because they help you avoid failure. That distinction matters more than most people realize. Avoiding big mistakes does more for long-term results than finding occasional winners. The math of recovery is unforgiving. A large loss requires an extraordinary gain just to return to neutral. That reality alone should shape how you evaluate risk. The first number is not exciting. It rarely appears in headlines. It does not make people feel clever for knowing it. Yet it quietly determines whether an investment deserves your time at all. That number is the price you are paying relative to what the business actually earns. Valuation is often discussed as if it were a technical exercise, but at its core, it is a behavioral discipline. It forces you to confront a simple question: how much optimism is already embedded in the price? When you buy a stock, you are not buying a story. You are buying a stream of future cash flows filtered through uncertainty. Paying too much for those cash flows is not a temporary mistake. It is a structural one. I learned this lesson slowly. In my early years, I paid little attention to valuation as long as the business seemed promising. Growth felt like a shield. If earnings were rising fast enough, I assumed the price would take care of itself. Sometimes it did. More often, it didn't. I would watch good companies deliver solid results, only to see the stock stagnate or decline. The business performed, but the investment disappointed. What I failed to understand at the time was that valuation sets expectations. When expectations are already extreme, even excellence can feel like a letdown. A high-quality business purchased at the wrong price can produce mediocre returns for years. A reasonable business purchased at a sensible price can quietly outperform. The number itself can be expressed in different ways: price relative to earnings, price relative to cash flow, price relative to normalized profits. The exact formula matters less than the mindset it enforces. You are asking whether you are paying a reasonable multiple for what already exists, not what you hope might happen. Hope is not a reliable input. Reality is. This number does not need to be precise. Investing is not physics. It needs to be conservative. If you find yourself justifying a high price with increasingly elaborate scenarios, that discomfort is the signal. Valuation should not require storytelling to work. When the margin for error disappears, risk quietly increases. As investors age, this number becomes more important, not less. Time has a way of amplifying both discipline and mistakes. In your 20s, overpaying for a good business may be recoverable. You have decades ahead, fresh income, and flexibility. In later years, the same mistake carries far more weight. Overpaying then often means holding dead weight much longer than expected, with less time and fewer options to correct the error. This is why valuation deserves respect, especially as time horizons shorten. Valuation is not about finding something that looks cheap on the surface. It is about acknowledging uncertainty. No forecast is precise. No growth story unfolds exactly as planned. Paying a reasonable price builds a margin of safety into your decisions. It gives you room to be wrong without being ruined. When you overpay, you are betting that everything goes right. That is not investing, that is hoping. As years pass, patience becomes more valuable, not less. Waiting for sensible valuations may feel uncomfortable in rising markets, but discipline compounds just like capital does. The goal is not to avoid mistakes entirely, but to make mistakes that are survivable. Valuation helps you do that. It keeps enthusiasm from overpowering judgment and reminds you that future returns are largely determined by the price you pay today. The second number is less visible, but arguably more important. It speaks not to what the business earns, but to what it owes. Debt is often treated casually during good times. Low interest rates make it feel harmless. Strong revenue growth makes it seem manageable. Balance sheets are ignored while income statements get all the attention. But debt has a way of changing the rules when conditions shift. It reduces flexibility, it limits choices, it turns temporary setbacks into permanent problems. A business without much debt can adapt, it can cut costs, pause expansion, or simply wait. A heavily indebted business does not have that luxury. It must keep moving forward, even when moving forward no longer makes sense. For investors, debt introduces risk that rarely appears in optimistic projections. It magnifies errors and shortens time horizons. Markets can stay irrational longer than a leveraged business can stay solvent. This is why conservative balance sheets matter more as you age. The goal shifts from maximizing upside to avoiding irreversible damage. In investing, survival is underrated. Valuation and debt are not exciting numbers, but they are protective ones. They don't promise brilliance. They quietly protect you from disaster. I once owned shares in a company that appeared strong by almost every surface-level measure. Revenue was growing, margins were healthy, analysts were optimistic. What I failed to appreciate was how much leverage sat quietly beneath those results. When the business hit a temporary slowdown, that leverage turned a manageable problem into a severe one. The stock did not decline gradually. It fell sharply because debt compresses time. Debt removes flexibility. It introduces urgency where patience would otherwise exist. A business without debt can endure a bad year. A highly leveraged business may not get that luxury. The market understands this instinctively, which is why stocks with fragile balance sheets tend to collapse quickly when sentiment shifts. The number that matters here is not complex. It is the relationship between what the company owes and what it generates. Can its earnings comfortably service its obligations? Could it survive a downturn without needing external help? Would it be forced to dilute shareholders or sell assets at unfavorable prices? Debt is not inherently bad. Used wisely, it can enhance returns. Used carelessly, it magnifies mistakes. The problem is that debt behaves asymmetrically. It helps quietly but hurts loudly. Investors often underestimate this imbalance because the negative consequences feel abstract until they arrive. Over time, I developed a simple habit. Before getting excited about a business, I look at its balance sheet, not in detail, not line by line. I ask whether the company has room to breathe, whether it controls its own timeline, whether management has optionality when conditions change. This number acts as a test of humility. It reminds you that no forecast is guaranteed. Businesses operate in environments they do not control. Interest rates change, demand shifts, competition intensifies. Debt reduces the ability to adapt. Companies with strong balance sheets survive long enough for patience to matter. The third number is the most subtle and perhaps the most misunderstood. It does not sit neatly on the surface of a balance sheet, and it does not announce itself in quarterly headlines. It does not move daily, and it rarely excites the market in the short run. Yet over long periods of time, it quietly determines whether an investment compounds wealth or merely consumes attention. That number is the return a business earns on the capital it deploys. This is the point where investing stops being an exercise in accounting and becomes an exercise in economics. Accounting tells you what happened. Economics tells you why it happened and whether it can continue. A business that earns high returns on capital can grow without harming its owners. A business that earns low returns must constantly struggle just to justify its existence. Growth by itself is not a virtue. Growth that requires ever-increasing amounts of capital at poor returns is not progress. It is value destruction disguised as momentum. Early in my investing life, I confused growth with success. Expanding revenues felt like confirmation. Larger footprints felt safer. Companies that were doing more appeared to be moving forward. What I failed to see was how much they had to give up to achieve that growth. Many of those businesses required continuous reinvestment, new plants, more inventory, additional staff, just to keep growing at the same pace. Capital flowed in relentlessly, but little of it returned to the owners in a meaningful way. Return on capital changes how you see almost every business decision once you truly understand it. It forces you to stop asking surface-level questions about growth and start asking a much harder one. What does each additional dollar invested actually produce? Not in theory, not in management presentations, but in reality over time and through different conditions. Does that dollar generate durable profit, or does it simply keep the machine running one more year? This distinction matters because capital is never free. Even when it comes from retained earnings, it carries an opportunity cost. That dollar could have been returned to owners, used to reduce risk, or invested elsewhere. When a company reinvests capital at low returns, it is quietly destroying value, even if revenue and earnings appear to be growing. The business looks busy, expanding, and productive, but the underlying economics are deteriorating. A business that earns high returns on capital operates from a position of strength. It does not need to reinvest everything it earns just to survive. It can afford to be selective. Management can pass on mediocre projects, return excess cash to shareholders, or wait patiently for opportunities that truly make sense. This flexibility is not a bonus feature, it is a structural advantage. Over long periods of time, it dramatically reduces the risk of permanent capital loss. In contrast, a business that earns low returns on capital is trapped. It must constantly reinvest just to maintain its position. New factories, new stores, new equipment, new spending, none of it optional. Growth becomes a necessity rather than a choice. And because each new dollar invested produces only modest returns, the company has to deploy more and more capital to achieve the same level of progress. The machine gets bigger, but not more efficient. Over time, this difference explains why some companies compound quietly for decades, while others remain perpetually active yet unrewarding. The high-return business may grow slowly, attract little attention, and rarely make headlines. But year after year, its retained earnings are converted into real value. The low-return business may appear dynamic, innovative, and ambitious. Yet despite all the effort, the results for owners remain disappointing. Return on capital also exposes the true cost of growth. Growth is often celebrated as an unqualified good, but it is only beneficial when it is profitable in an economic sense. A company may double its revenue over 5 years, but if it must triple its capital base to do so, the owners are worse off. More assets, more risk, more complexity, and lower efficiency, all in exchange for the appearance of progress. Compare that to a company that grows slowly while reinvesting modest amounts at very high returns. Its revenue may not impress, its expansion may look cautious, but each dollar retained compounds at an attractive rate. Over time, this creates an outcome that spreadsheets often fail to capture: durable, owner-friendly wealth creation. On paper, the fast grower looks superior. In reality, the slow, efficient compounding business is doing the heavy lifting. Return on capital strips away illusion. It ignores stories, ambition, and effort. It does not care how hard management is working or how compelling the narrative sounds. It simply asks whether the business converts capital into value. When you view companies through this lens, many popular investments lose their appeal, while some unglamorous ones suddenly make sense. For investors, this perspective brings discipline. It shifts focus away from short-term excitement and toward long-term economics. It encourages patience, restraint, and respect for efficiency. Most importantly, it aligns investing with reality rather than hope. In the long run, wealth is built not by activity but by effectiveness. Return on capital reveals which businesses are truly effective. Businesses that earn high returns on capital tend to share certain traits. They often possess pricing power, allowing them to raise prices without losing customers. They occupy favorable competitive positions protected by brand, network effects, switching costs, or regulatory barriers. They do not require constant reinvention simply to stay relevant. Most importantly, they do not need excessive capital to maintain or extend their advantages. These characteristics are difficult to replicate, which is why high returns, when sustained, tend to persist longer than most expect. At the same time, this number disciplines expectations. High returns inevitably attract competition. Capital flows towards success. Sustaining superior returns requires more than intelligence or ambition. It requires structural advantage. When you see a business earning strong returns on capital year after year across different economic environments, you are not witnessing luck, you are witnessing durability. And durability, more than excitement, is what compounds. I once compared two companies operating in the same industry. One was constantly in the news, expanding aggressively, announcing new initiatives every year. The other was quieter, slower, and largely ignored. The first showed faster growth. The second showed consistently higher returns on capital. Over the next decade, the second produced meaningfully better shareholder outcomes, despite appearing less interesting in any given year. That experience stayed with me. It reshaped how I define quality and where I focus my attention. These three numbers, valuation, debt, and return on capital, work together. Valuation controls what you pay. Debt controls what can go wrong when conditions change. Return on capital controls what can quietly compound over time. None of them guarantee success on their own. Together, they narrow the field to businesses that are resilient, efficient, and reasonably priced. That does not eliminate mistakes, but it reduces the likelihood of regret. Notice what is missing from this framework: forecasts, predictions, economic narratives, macro opinions. These elements feel important, especially in the moment, but they are unstable. They shift with sentiment, headlines, and storytelling. Numbers grounded in business reality endure longer than opinions about the future. They anchor decisions when narratives change. The purpose of focusing on only a few numbers is not simplicity for its own sake. It is protection, psychological as much as financial. When you track too many metrics, you invite constant adjustment. Adjustment leads to activity. Activity creates the illusion of control, but often results in error. A small set of meaningful constraints encourages patience. Patience, when combined with sound economics, is one of the most powerful advantages an investor can have. Patience is often misunderstood as inaction. In reality, it is structured restraint. It is choosing not to respond to noise. It is allowing time to work without interference. The market rewards this behavior not because it is virtuous, but because it is rare. Over time, I noticed a pattern in my own results. The investments I monitored most closely produced the weakest outcomes. The ones I understood clearly and left alone performed best. Understanding did not come from knowing everything. It came from knowing what mattered. These numbers also help separate decision quality from outcome. A well-priced, conservatively financed, high-return business can still produce a poor short-term result. That does not invalidate the decision. A speculative purchase can produce a quick gain. That does not validate the process. This distinction becomes more important as time horizons lengthen. Short-term outcomes are noisy. Long-term outcomes are shaped by structure. The numbers you choose to respect define that structure. As investors age, this approach becomes less about maximizing returns and more about protecting progress. Capital preservation and steady compounding begin to matter more than occasional brilliance. The cost of large mistakes increases as time becomes less flexible. There is also emotional relief in this framework. You stop reacting to every market movement. You stop feeling pressured to have an opinion on everything. You accept that you cannot control outcomes, only decisions. I have met investors who track dozens of indicators and still feel anxious. I have met others who focus on a handful of principles and sleep well. The difference is not intelligence. It is alignment. Alignment between goals and behavior matters more than sophistication. A simple, disciplined approach consistently applied outperforms a complex approach inconsistently followed. This is not theory, it is observed reality. The market offers endless distraction. New narratives appear daily. Innovation never stops. None of that requires your participation. You are allowed to be selective. You are allowed to ignore most of what happens. Focusing on a few essential numbers is not about limiting opportunity. It is about filtering temptation. It keeps you from confusing excitement with progress. It reminds you that investing is not entertainment. Over time, this mindset changes how you experience markets. Volatility becomes background noise. Drawdowns feel tolerable. Gains feel earned rather than lucky. Confidence grows quietly, not from prediction, but from preparation. The goal is not to find the perfect stock. It is to build a process that survives imperfection. These three numbers do not eliminate risk, they make risk visible. Investing well is less about brilliance and more about restraint, less about speed and more about endurance, less about being right and more about not being wrong in irreversible ways. When you strip investing down to its true essentials, clarity begins to replace confusion. The noise fades. The charts, predictions, headlines, and daily opinions lose their power. What remains is surprisingly simple. You pay close attention to what you pay. You respect what can break. And you favor businesses and assets that compound efficiently over long periods of time. Everything else, no matter how intelligent it sounds, is secondary. This way of thinking is not exciting. It doesn't deliver adrenaline or bragging rights. It won't give you dramatic stories to tell at dinner parties about how you timed the market or spotted the next big thing early. In fact, most of the time it feels almost boring. And that's precisely why it works. Investing is not about constant action. It's about avoiding unnecessary mistakes, paying too much for growth that may never arrive, ignoring risks that only reveal themselves during bad times, chasing complexity when simplicity would have done the job better. The market doesn't punish people for being cautious. It punishes people for being careless. Respecting what can break is especially important. Leverage fragile business models, excessive optimism, and dependence on perfect conditions all look harmless during good times. They only reveal their danger when stress appears. The goal isn't to predict every crisis. It's to build a portfolio that can survive them without forcing you into bad decisions. Then there is compounding. Real wealth is rarely built through dramatic moves. It is built through steady returns that are allowed to work uninterrupted for years, sometimes decades. High-quality businesses reinvesting at strong returns, simple strategies followed with discipline. Time doing the heavy lifting while you stay out of the way. This approach will never make you feel clever in the moment, but it rewards patience, humility, and restraint. And in investing, what works quietly over time is infinitely more valuable than what impresses briefly. In the end, the only numbers that truly matter are the ones that help you stay invested, stay disciplined, and stay aligned with the life you want to live. Not daily prices, not predictions, not opinions, just durability, value, and time. Time does the heavy lifting. Your job is simply not to interfere. If you found this perspective useful and want more clear, thoughtful investing ideas like this, subscribe to the channel and stay with us.